They must be unstoppable or absolutely reckless, one skeptical onlooker muttered when the news broke that yet another major corporation had scooped up a massive new trove of bitcoins. Can you imagine pouring billions upon billions of dollars into a digital currency that a decade ago was barely a whisper among tech enthusiasts? We are witnessing a modern gold rush in cyberspace, and it is no mere novelty. Instead, it feels more like the furious crescendo of a global financial revolution, permeating boardrooms, government halls, and seemingly quiet corners of the institutional investing world. So, what is really happening here? And why are so many titans of business, entire national governments, and enormous exchange-traded funds chasing down this elusive resource as if it were the last drop of water in a desert? Today, we will untangle the mesmerizing story behind this frenzied Bitcoin buying spree. More importantly, we will crack the question echoing through the marketplace. If almost everyone is snapping up the coins, then who on earth is selling? In this deep dive exploration, we will uncover the cast of major Bitcoin hoarders, the scope of their purchases, the surprising entities quietly offloading their Bitcoin, and the broader drama of a market tipping ever so delicately between supply and demand. Speaking of drama, do not forget to show some support if you enjoy moments like these. Give this content a like if you sense a rush of intrigue about where the money is coming from and where it is going. But fasten your seatbelt. The deeper we go, the more astonishing details we will uncover about the extraordinary movement behind Bitcoin's circulating supply. Let us begin with a spectacle so large it can be measured in the billions of dollars. Companies like MicroStrategy, Metaplanet, Semler, and Coinbase have been on colossal Bitcoin buying streaks since the beginning of 2023. When we say colossal, we mean true mountains of digital currency that most ordinary people would only dream of. In total, these publicly traded stocks have devoured more than 251,700 bitcoins since January of this year alone. That is an astronomical figure, translating into well over 26.5 billion United States dollars if we measure it at current market prices. If that figure alone does not make your jaw drop, consider that this insatiable demand is more than triple the number of fresh coins mined in that same stretch of time. That sets the stage for a thought-provoking question. If so many corporate whales are buying, is there even enough new Bitcoin to meet this appetite? The supply of newly minted Bitcoins is famously tight, a reality that intensifies each time the Bitcoin network experiences a halving event. Indeed, many crypto observers have been left scratching their heads, wondering whether the entire market might be heading toward a supply imbalance, potentially fueling a fear of missing out so profound that it pushes prices ever higher. But wait, there is more. It is not just the big corporations jumping into the Bitcoin mania. Tether, which is among the most recognizable private companies in the crypto space, has quietly accumulated about 20,800 Bitcoins this year, worth somewhere around 2.2 billion United States dollars. Countries and governments have hopped on the train too. Bhutan, a tiny but technologically forward-thinking kingdom, has not hidden its stake in the crypto realm. Then, of course, there is El Salvador, led by a president famous for championing Bitcoin as a key to modernization. These private and governmental entities have snatched up scores of coins, further tightening the supply available on the open market. And let us not forget about the financial juggernauts in the form of exchange-traded funds. Around the globe, Bitcoin ETFs have expanded their total holdings by roughly 149,100 Bitcoins, a stockpile that equates to about 15.7 billion United States dollars. This particular wave of buying is heavily influenced by the likes of BlackRock's iShares Bitcoin Trust, often abbreviated as IBIT, which alone has grown to hold more than 130,850 Bitcoins, the equivalent of about 13.8 billion United States dollars, just since the start of this year. Add everything together, and these sums become breathtaking. A quick assessment indicates that governments, private companies, public stocks, and ETFs have collectively tucked away at least 400,800 Bitcoins in 2023. That amounts to around 2% of the circulating supply of the world's most popular cryptocurrency, all scooped up in less than 1 year. With so much buying mania swirling around, it is no wonder that onlookers are beginning to ask, sometimes with an undertone of alarm, that is all very thrilling, but who is actually selling these Bitcoins and at these prices? One possible culprit might come to mind: miners. After all, Bitcoin mining is a global industry responsible for generating new Bitcoins, so it might make sense that miners are the ones dumping their freshly minted coins onto an insatiable market. The truth, however, is more nuanced than you might expect. While it is true that data indicates crypto miners collectively hold around 1.8 million Bitcoins, a staggering 9% of circulating supply, they collectively have offloaded a net total of roughly 2,000 Bitcoins since January of this year. That is only a drop in the bucket compared to the massive buying spree we have just described. However, because the total value of their collective holdings has soared to all-time highs, some miners are gradually capitalizing on that growth, liquidating just enough to fund their operations while retaining a substantial portion of their reserves. If not the miners, perhaps it is a small subset of exchange-traded funds or trust providers that are more quietly but steadily selling. In fact, somewhat under the radar, more than half the existing ETFs around the world have been trimming their Bitcoin positions during the year. Fidelity's FBTC, for instance, has reportedly exited over 6,500 Bitcoins since January. Even more dramatic is Grayscale's Bitcoin Trust, which is believed to have sold over 20,000 Bitcoins. The Grayscale empire includes a mini trust and several funds with strategic holdings, but not all of them are net buyers. Combining those passive sales from ETFs with the modest sells from miners might partially explain the liquidity fueling the unstoppable corporate and governmental acquisitions. Nevertheless, the contradiction remains striking. Huge sums of Bitcoin are being locked away into the vaults of major corporations, small countries, and massive funds. Indeed, some folks might argue that this phenomenon borders on the mind-boggling, as it poses serious questions about whether there will be enough Bitcoin left in circulation for retail investors eager to participate in this market. Anxiety could set in if more and more people start to worry they simply will not have a chance to buy into the cryptocurrency at a reasonable entry price. However, do not just take my word for it. If you find yourself intrigued by the monumental scope of these transactions, consider subscribing for more breakdowns on the crypto markets and all the bizarre, thrilling maneuvers that shape this ever-evolving industry. After all, just when you think you understand the routine of the Bitcoin market, another monster wave of institutional movement can crash onto the scene, capturing everyone's attention and their wallet addresses. Let us dig further into the drama. Imagine the perceived threat of a shortage, as well as the potential for Bitcoin's price to catapult. On one side, you have a growing horde of diamond-handed entities, including governments that see Bitcoin as a strategic reserve, corporations that view it as a secure store of value, and leading investment funds that have integrated it into mainstream portfolios. Meanwhile, overshadowing this bullish parade, you have a thin yet persistent stream of sales from other funds that seem to be taking short-term profits or realigning their portfolios. Miners, for their part, are harvesting new blocks, but the quantity they sell is dwarfed by the accumulating positions of more prominent players. It is reminiscent of a seesaw with one side weighed down by enormous corporate appetite and the other side barely lifted by a scattering of sellers, enough to keep the entire system from capsizing, but not so large as to overshadow the whales. This dynamic begs the pressing question of sustainability. Could we reach a moment when so many coins end up locked away that effectively we cannot have a liquid market? Or will there always remain enough profit takers, opportunistic sellers, or new miners to maintain equilibrium? Some analysts theorize that small and medium holders, especially those who have anticipated a major price run-up, might be willing to exit the market at certain price thresholds. Thus, the day-to-day fluctuations in Bitcoin's price could be partly governed by these mid-level exits, effectively revitalizing the pool of available coins for bigger fish. Retail speculators may also be flipping some of their positions into stablecoins, like Tether, or rotating into other cryptocurrencies, freeing up a tally of Bitcoin that is magnetically drawn to the behemoths of institutional finance. Still, it is fascinating how the core of the question, who is selling, reveals a kaleidoscope of motivations, from strategic rebalancing by particular ETFs to operational costs for miners, from local traders who see a profit window to institutions that might anticipate or plan a shift in market cycles. There may be no single grand villain orchestrating a giant sell-off. Instead, it appears to be a patchwork of moderate dispositions, each one adding up to provide the liquidity demanded by the ferocious accumulation spree. Further complicating the puzzle is that certain selling actions fly beneath the radar. Not every entity that liquidates a stash has to file regulatory disclosures, especially if they are smaller sellers or private individuals. In the swirl of daily crypto trades on the global market, there are countless hidden hands pulling the lever to sell for reasons unknown to the general public. People buy houses, send children to college, or want to hedge against the next big meltdown of the financial system. Those motivations, multiplied by thousands, possibly millions, also feed the other side of the equation, albeit more discreetly than a publicly listed enterprise brandishing headlines about another corporate purchase. Amid all of this, fear and excitement swirl in equal measure. The dream of a drastically limited supply, combined with towering demand from major market players, sparks speculative chatter that the price of Bitcoin could skyrocket into previously unimaginable territory. On the other hand, skeptics point out that no asset can climb forever without encountering periods of consolidation, correction, or downright recession. So, is the unstoppable wave of institutional buying a bubble waiting to burst? Or is it the early harbinger of an era in which Bitcoin stands front and center in the global monetary stage? One should remember that over the 12-plus years since Bitcoin's genesis, the cryptocurrency has endured near-fatal price collapses, botched exchange failures, regulatory clampdowns, and ceaseless skepticism. Yet it has continued to emerge more resilient after every storm. This cyclical phenomenon might fuel the mindset of many institutional participants. If you believe in the long-term trajectory, perhaps now is the time to buy and hold, ignoring the day-to-day noise. Of course, conspiracy theories abound regarding hidden sellers. Are there large private investors who just prefer to operate under the radar? Might some of the earlier whales, those who got in at pennies or mere dollars per Bitcoin, be the real providers of liquidity for these newly minted institutional players? After all, if you first acquired thousands of Bitcoins years ago at negligible cost, cashing in even a shred of your stash would still deliver life-altering returns. As we have seen, though, the deciding factor is not just about the presence of sellers, but about the pace at which sellers meet the avalanche of demand. Perhaps no single group is championing the offload. Rather, a smattering of profit-takers, older whales, rebalancing funds, and life events from everyday holders collectively supply the market. Combine that with modest miner selling, and you get enough fuel to satisfy the unrelenting appetite of major corporations, countries looking to experiment with digital currencies, and the unstoppable spread of Bitcoin ETFs looking to serve mainstream investors hungry for exposure. If all of this whets your appetite for more profound insights and analysis on just how these players orchestrate their strategies, do not forget to stay connected for future deep dives. Sharing your thoughts or subscribing ensures that you never miss out on the next big unveiling of hidden crypto movers and shakers. Because, believe me, the pace at which new announcements keep rolling in is downright dizzying. Each day seems to reveal a new wave of significant purchases, fresh developments in the regulatory environment, or surprising revelations where we discover an additional government or corporation quietly stacking coins in record amounts. So let us circle back to the crux of our story. If corporate giants, entire nations, and a growing suite of exchange-traded funds are vigorously building up their Bitcoin positions, then who is letting go of enough Bitcoin to keep the market afloat? Despite the sensational headlines, the answer appears to be less about any single, monolithic seller and more about a complex tapestry of smaller but persistent sellers. Miners are part of that tapestry, albeit modestly so. A noteworthy portion of ETFs have trimmed their holdings, presumably to lock in gains or match their strategies to shifting market conditions. And then, behind the scenes, countless lesser-known individuals and smaller funds must be contributing their fair share of Bitcoin to the market, some of them likely propelled by life events or strategic shifts that happen well beyond the glare of publicity. In many aspects, the phenomenon is reminiscent of a puzzle. Each puzzle piece conveys a different story, from profit-taking to reallocation, from covering cost of living expenses to responding to corporate or government policy decisions. And when each mosaic piece is laid out on the board, the big picture emerges. Demand from big players can be satisfied only because a myriad of smaller or mid-sized hands are willing to relinquish at least some of their Bitcoins. This willingness might stem from an urge to profit, a desire to diversify, or simply the necessity of paying bills. Meanwhile, public disclosures are like signposts showing us the high-level direction of large funds, whereas the daily churn from smaller traders remains an elusive but critical component. For those bullish on Bitcoin, this equilibrium could be a sign of market resilience. If demand surges but remains balanced out by supply, the asset can potentially grow in a steadier, more sustainable fashion. On the flip side, if the appetite of corporations, governments, and ETFs continues accelerating, while everyday individuals decide to hold on to their coins, it might spark more dramatic shortfalls in circulating supply. That scenario could drive prices up precipitously, but also might invite more speculation, volatility, and regulatory scrutiny. Either way, the stage is set for a dramatic story, and we are all watching with rapt attention. Corporations do not just invest in Bitcoin on a whim. Governments do not simply add it to their balance sheets by accident. And massive funds are rarely so determined to keep increasing positions in an asset that lacks fundamental staying power. Clearly, the brand of a digital store of value or a hedge against inflation resonates in the hearts of many. That alone can sustain the fervor for quite a while. So, the short answer, who is selling, is that there is no single, sinister group. Instead, a variety of smaller yet meaningful participants are collectively handing over their precious Bitcoins to the whales. Indeed, across the first several months of 2023, it is those incremental flows from smaller wallets, partial ETF rebalancing, and the occasional minor or institutional trust that have supplied the billions of dollars in digital currency demanded by MicroStrategy, Metaplanet, Semler, Coinbase, Tether, Bhutan, El Salvador, and that crowd of hungry ETFs from around the globe. One should probably keep a watchful eye on how Grayscale, Fidelity, and others might decide to approach the market in the coming weeks and months. Will they continue to trim or resume accumulating? Will the corporate mania subside due to macroeconomic shifts? Or are we just at the beginning of a multi-year wave of unstoppable corporate accumulation, reminiscent of how some companies once hoarded gold? In all likelihood, the unstoppable narrative of Bitcoin's adoption among influential players will keep forging ahead with twists. The deeper we dig, the more we see that widespread adoption and occasional pockets of fear or exhaustion among regular sellers form the core tension in this storyline. Regardless of which side you find most compelling, one thing is certain: the cryptosphere never lacks for sudden drama, big moves, or extraordinary transformations. Stay tuned, dear watchers of the cryptoverse, because as we have explored, even though the big names are swallowing up massive amounts of Bitcoin, a hidden army of smaller sellers stands behind the curtains, gradually dispensing the coins that keep this wild, whirling market in motion. Our collective curiosity drives the excitement, the speculation, and ultimately the trust that spurs so many into staking real capital in this intangible asset that has proven to be anything but boring.